the systematic process of recording all financial transactions of a business. It forms the foundation of financial management and business decision-making. Think of bookkeeping as maintaining a detailed financial diary for your business. Every transaction, whether money coming in or going out, gets recorded systematically. Every business transaction gets recorded. Sales that bring money in, expenses that take money out, and purchases of supplies or equipment. All these transactions flow into your financial records, creating a complete picture of your business's financial activity. Proper bookkeeping allows you to monitor your business's financial health in real time. You can see if you're making a profit, track your cash flow, and understand your overall financial status. Good bookkeeping enables informed business decisions. Should you expand your business? Can you afford new equipment? Is it time to hire more staff? Your financial records provide the answers. Throughout this series, you'll master the fundamental concepts of bookkeeping, learn about different financial statements, understand various bookkeeping methods, explore modern technological trends, and see real-world applications through case studies. By the end of this series, you'll have a solid foundation in bookkeeping principles and understand how modern technology is transforming the field. Whether you're a business owner, aspiring bookkeeper, or simply want to understand financial management better, this knowledge will serve you well. Revenue and expenses are the two fundamental components that determine a business's profitability. Understanding these concepts is essential for effective bookkeeping and financial management. Revenue represents all the money a business brings in from its core operations. This includes sales of products, fees for services, and other income-generating activities. Common sources of revenue include product sales, service fees, subscription income, and licensing fees. Each dollar that comes in from these activities contributes to the company's total revenue. Now let's examine expenses, which represent all the costs a business incurs to operate and generate that revenue. Expenses are the costs that businesses must pay to keep their operations running. These include rent for office space, employee salaries, utilities, marketing costs, and many other necessary expenditures. Common business expenses include rent, employee wages, utilities like electricity and internet, marketing and advertising costs, and office supplies. Each expense reduces the company's overall profitability. The relationship between revenue and expenses determines a company's profit. This fundamental equation forms the basis of the profit and loss statement. Here we can see the fundamental relationship. Profit equals revenue minus expenses. Using our example, $85,000 in revenue minus $65,000 in expenses equals $20,000 in profit. Tracking revenue and expenses is essential for creating the profit and loss statement, also known as the income statement. This financial report shows a company's profitability over a specific period. By accurately recording every dollar that comes in as revenue and every dollar that goes out as expenses, businesses can track their financial performance, make informed decisions, and ensure long-term profitability. The chart of accounts is the foundation of any bookkeeping system. It serves as a comprehensive list that organizes all the accounts used to record financial transactions in your business ledger. Think of it as a filing system for your financial data. Every transaction your business makes gets recorded in a specific account, and the chart of accounts ensures everything is properly organized and categorized. The chart of accounts organizes all accounts into 5 main categories. Assets represent what your business owns, liabilities are what you owe, equity is the owner's stake in the business, revenue is money earned, and expenses are money spent to operate the business. This diagram shows how accounts are organized hierarchically. The chart of accounts splits into balance sheet accounts and profit and loss accounts. Balance sheet accounts include assets and liabilities, while profit and loss accounts include revenue and expenses. Most businesses use a numbering system to organize their chart of accounts. Typically, assets are numbered in the 1000s, liabilities in the 2000s, equity in the 3000s, revenue in the 4000s, and expenses in the 5000s. This systematic approach makes it easy to locate and categorize accounts. Accounts can also be classified in different ways. This flowchart shows the traditional classification into personal and impersonal accounts. Personal accounts relate to people or entities, while impersonal accounts include real accounts for tangible items and nominal accounts for revenues and expenses. Here are common examples of accounts in each category. Asset accounts include cash, accounts receivable, inventory, and equipment. Liability accounts include accounts payable, bank loans, and credit cards. Revenue accounts track different types of income, while expense accounts record various business costs. This table shows how a chart of accounts looks in practice, with specific accounts listed under each category along with their current balances. Notice how each account has a clear category and monetary value, making it easy to prepare financial statements and track business performance. A well-structured chart of accounts is essential for several reasons. It ensures accurate financial reporting by providing consistent categorization. It simplifies the process of recording transactions by giving clear guidance on where each transaction belongs. It facilitates easy account lookup through logical numbering, and it enables better financial analysis by organizing data in meaningful ways. Remember, your chart of accounts is the backbone of your bookkeeping system. Taking time to set it up properly from the beginning will save you countless hours and ensure your financial records are accurate and useful for making business decisions. The revenue recognition principle is one of the most fundamental concepts in accounting. It determines exactly when a business should record revenue in its financial statements, ensuring accuracy and consistency across all financial reporting. Revenue recognition requires meeting two essential criteria simultaneously. First, the revenue must be earned, meaning the company has delivered goods or performed services. Second, the revenue must be realized or realizable, meaning payment has been received or is reasonably certain to be collected. It's important to distinguish between revenue and income. Revenue, also known as sales or the top line, represents money from selling goods or services. Income or net profit is the bottom line after subtracting all expenses from revenue. Revenue recognition specifically deals with when to record that top-line revenue. There are 4 primary methods for recognizing revenue, each suited to different business situations. The completed contract method records revenue only when a project is entirely finished. The installment method recognizes revenue as payments are received over time. The cost recovery method waits until all costs are recovered before recognizing profit. The percentage of completion method records revenue based on project progress. Revenue recognition standards have evolved significantly in recent years. Between 2014 and 2019, new comprehensive standards were developed and implemented to create greater consistency across different industries and improve the quality of financial reporting worldwide. Consider a software company that signs a contract in January, delivers the software in March, and receives payment in May. Under the revenue recognition principle, revenue should be recorded in March when the software is delivered, not when the contract is signed or payment is received. This ensures revenue appears in the correct accounting period. The revenue recognition principle is essential for 3 key reasons. First, it ensures accurate financial reporting by preventing companies from manipulating when they record revenue. Second, it matches revenue to the correct time period, giving stakeholders a true picture of business performance. Finally, it provides consistency across different businesses and industries, making financial statements more comparable and reliable. Cloud-based bookkeeping represents a revolutionary shift from traditional desktop software to internet-based financial management systems. These solutions store your financial data securely in the cloud, accessible from anywhere with an internet connection. The first major advantage of cloud-based bookkeeping is enhanced accessibility. Your financial data is available 24/7 from any device, whether you're at the office, at home, or traveling for business. Security is another crucial advantage. Cloud providers invest heavily in advanced security measures, including encryption, regular backups, and multi-factor authentication, often providing better protection than traditional on-premise solutions. Cloud-based solutions excel at enabling collaboration. Multiple team members, accountants, and business owners can access the same real-time data simultaneously, eliminating version control issues and improving communication. The comprehensive benefits of cloud computing extend beyond basic accessibility. Cost savings, centralized data security, loss prevention, and valuable business insights make cloud-based bookkeeping an intelligent choice for modern businesses. The efficiency gains from cloud-based bookkeeping are substantial. Automatic updates, seamless integrations with other business tools, and reduced IT maintenance requirements allow businesses to focus on growth rather than technical management. Cloud adoption in bookkeeping continues to accelerate as businesses recognize these advantages. The future of financial management is clearly moving toward cloud-based solutions that offer unprecedented flexibility, security, and collaborative capabilities. As bookkeeping moves increasingly into the digital realm with virtual services and cloud-based solutions, cybersecurity has become absolutely critical for protecting sensitive financial data. Bookkeepers face numerous cybersecurity threats that can compromise sensitive financial information. Phishing emails attempt to steal login credentials, malware can infect systems and steal data, and ransomware attacks can encrypt and hold financial records hostage. To protect against these threats, bookkeepers must implement robust security measures. Multi-factor authentication adds an extra layer of protection beyond passwords. Data encryption ensures that even if data is intercepted, it cannot be read. Regular backups provide recovery options if systems are compromised. Cloud-based bookkeeping solutions offer enhanced security features, including reliability, built-in security measures, and cost-effective protection. However, businesses must still implement proper security protocols when using these services. Small businesses must implement comprehensive cybersecurity measures to protect their financial data. This includes employee training, secure password policies, regular software updates, and monitoring for suspicious activities. Implementing cybersecurity best practices is essential for protecting financial data. This includes using strong passwords, keeping systems updated, training staff on security awareness, monitoring for suspicious activities, and establishing secure protocols for file sharing and data access. As bookkeeping continues to evolve with digital technologies, cybersecurity remains a fundamental responsibility. Protecting financial data is not just about technology. It requires ongoing vigilance, proper training, and a comprehensive security strategy. Meet Fancy Dancer Boutique, a family-owned dancewear store in Texas. Like many small retail businesses, they were facing serious cash flow challenges that threatened their survival. The store was experiencing a severe cash flow crisis. Monthly cash flow was declining rapidly, with unpaid supplier invoices piling up, late rent payments, and inventory shortages becoming common problems. The family decided to hire a professional bookkeeping service to modernize their financial management. The service provided daily transaction recording, accounts payable management, cash flow forecasting, and regular financial reporting. The new bookkeeping system implemented streamlined processes for purchasing, accounts payable, and financial management. This included automated invoice matching, streamlined payment approvals, and real-time financial updates. The results were dramatic. Within 6 months, the store's cash flow improved from negative $6,000 to positive $12,000. Payment processing time decreased from 45 days to just 15 days, and supplier relationships improved significantly. This case study demonstrates how professional bookkeeping services can transform a struggling small business. The key success factors included expert financial management, systematic processes, real-time visibility, and improved cash flow control. Fancy Dancer Boutique went from the brink of closure to a thriving business, proving that accurate bookkeeping is essential for small business success and sustainable growth.